Hi there, a very good morning, good afternoon to all of you, depending on wherever you're watching me. This is Simply Stocks, and I'm here with another video. And this is the first video in terms of investment tutorial that I bring to you. Hopefully, in the next months or so, in the next 1 year, I'm going to come up with multiple videos of investment tutorials on every Friday. So, beginning with a, a small tutorial on investments, beginning with the stock markets and what it is all about and how things go about. So we'll discuss about this, and whatever your queries are or any suggestion that I want to imbibe into this tutorials, I have made some presentations and I'll add on to that once I get more suggestions. So do support me, do hit that subscribe button so that I get my subscribers up, which has been languishing around 43,000 for many months, and you might have been seeing that. So whoever watching this video, do subscribe. So let's get started. First of all, a disclaimer that this is not a stock recommendation, and whatever discussions I have is purely on the basis of my experience into the market. I'm a retail investor. I am not a member of the NSE and BSC. So whatever decisions with respect to investments you take, kindly do consult your financial advisor. So let me just take you to the presentation, but before that I want to just give you an idea of the markets as well. So we'll discuss about the markets. Let me just get you there. So this is the indices, all the indices, and what I want you to focus on, because of the current situation across the border, and the Indian Army is doing a magnificent job, so salute to them. First of all, India VIX is around 22, 22 and a half. Now this is highly risky kind of environment for somebody who's trading. So that's my call for those who are trading intraday, who are trading for even shorter terms, that things will be extremely volatile for the next at least couple of weeks until this settles down, this skirmish, this war settles down between India and Pakistan. So once this VIX goes past say 23 or so, then things can get extremely ugly. So what I see here is that we went to 23.2. So once this goes beyond 23, the fall could be even more accentuated. We are below 24,000. I won't be surprised if we go to 23,500 soon, and then even below that. That's your 200, that's your 50-day moving average. We have already breached the 200-day moving average. So 23,500 looks imminent, and even levels below that is looking a possibility. So be extremely careful. That's what I want to say. For the next couple of weeks, at least for this month, things could be extremely volatile, and that's why I have invested my money for a period of at least 2.5 3 years, and not less than that, and that could be a prudent strategy. Now another thing I want to mention here, apart from subscription, is that if you become a member here on Patreon with me on Simply Finance, you can get updates on the portfolio, whatever my portfolio is, any changes that I'm making, short-term, long-term trades. I do come in and talk about it, and there are investment picks and talk about global and local economies and how things are panning out, everything, and whatever queries you're having, I'm answering that. So you can be a member here as well. So let's begin with the investment tutorial session 1. So this is all about investing. Session A, what are equities, etc. I'll just go by it very quickly. So let me just begin it. Basically, stock is you become a part owner of the company, or you own that company to a certain extent, whatever amount you buy into a company, and whenever the company makes money or loses money, whenever company comes out with results and they are making good amount of money, the stock prices go up and you also make money along with them. So you are a minority shareholder in there, and you have all the rights such as voting rights with the company. In terms of stock markets, a place where shares are traded, Amsterdam in Netherlands had the first exchange in 1602, and every nation virtually has a sovereign nation has a stock market, and prominent global markets are in US, which is Dow Jones and the Nasdaq, etc. We have England, we have France with the CAC, and Germany with the DAX, and Japan with the Nikkei that we are having. England has FTSE, Financial Times Stock Exchange. So India has Sensex and Nifty. Sensex came in at 1875 in 1875, and Nifty in 1992. That's how things have panned out. So uh, that's one thing. Now, so why to invest at all? This is basically to counter inflation. So one needs to understand that inflation currently in India, it looks like it's 5-6%, but inflation currently is more than 10% if you look at certain commodities, certain, you can say, food products. And even if you go further into the picture, and if you dig deeper, inflation for medical expenses is around 14%. It doubles every 4 5 years. 14-15% is your inflation there. For education, it's more than 10%. So when you're talking of 9-10% inflation overall, if you're considering your expenses from a period of say 5-10-15 years, it just balloons to a huge level. So bank interest and FDs cannot cover that. Interest is in the bank saving account is around 2.5-3%. FDs would give you 6-6.5% post tax. And that is the biggest problem. Yes, it could be safer, but eventually you're losing money over a longer period of time. Yes, it's a safer bet. It can be part of your asset allocation, but overall you cannot beat uh, beat your expenses, at least here in India, with this kind of investments, because the inflation rate is extremely high. So options are mutual fund, Nifty B's, direct equity. Specific stocks or buying into direct equity is risky, yet it can be more fruitful. So I can vouch that people are making around say 20%, 18-20% CAGR in the last 5 years because of investing into the Indian market. And even Nifty has given such sort of return, or sorry, small cap and mid caps have given very handsome returns over the last 5-6 years. But that doesn't remain sacrosanct over a 30-40 year period. So everything changes. So we are seeing that the small cap, especially small cap stocks, mid cap stocks, over the last 6-8 months hasn't been performing that well, and Nifty is now doing well. So it's extremely hard. I can tell you that it is extremely hard to pick stocks and make money through it over a longish period of time. You can probably trade for a little while, but you won't be able to make big money unless you are deep into all the companies, and that is your per se work of finding out companies and investing into it. So what is the best way out is probably the mutual funds way, even though I'm not a huge fan of it. But those who are into job, those who don't have time, should get into Nifty B's and mutual funds, and probably make around 10 to 12% post tax. It's around 10 to 12%. Around that, you will get, if you have a 5 to 10 year time horizon, you will get between 10 to 12% primarily. That's what has been the history over the last 60, 70, 80 years across the globe in the market. So that's where the money is made. So at least you might just with a smidgen beat the stock market. So compounding is your best friend in the markets. Anything that can grow 18% annually, as I said, doubles in 4 years. Anything growing at 14.5% doubles in 5 years. And that is the problem, that in India, the at least the education as well as the medical expenses is doubling every 5 years, and you cannot grow your money over 5 years or double your money over 5 years with FDs or just putting money in the bank. So investment of 10 lakh for 30 years can be 100 crores at 25% CAGR. That's how things are. So if you pick very good companies, and those companies do grow 25-30% over that period, and that happens over 20-30 years. There are champion companies who have been growing at 22, 25, 27%, and that's where big money is made. The effort is in finding those kind of companies, and that's why long term investment is extremely essential, and one should be doing that. So some mega compounders over the last 20-30 years, Asian Paints, which has slowed down over the last 5 years, have been huge compounders from 1990s. These are all companies from 1990s which have done extremely well. Hindustan Unilever, Pidilite, Titan, TCS, Infosys. Divi's, iShare. Now, which are the smaller companies which could do extremely well? I keep delving into it, and you can get some videos on it. Right at the end of this video, I have put up a video of a company where I analyze that. So I do keep analyzing small cap companies, and for that videos would be coming in every Saturday. So tomorrow another video for that would be coming in, but the rate of success for small caps are extremely less. So it's around say 2-3%. So 100 companies, if we analyze, then 2 to 3 companies will uh, become like an Asian Paints, etc. So be very careful on that, and that is why it is prudent, again I am saying, to invest through Nifty Bs or funds. So why do India not invest into the market? Less than 4% of Indians do invest into the market, and that figure is extremely large globally. Now, the reason for that to not invest into the market is the you can say love towards gold. That's one thing that people do invest into gold first of all. And since your ancestors or our ancestors, our fathers, grandfathers have invested into property and they have made big money because property prices went through the roof during the early 2000s till 2007. And so those who have got into property in the 90s have made billions and have made big money, 20, 30, 40, 100x. And that's why, and property seems like an hard asset where prices do not fall, although there are times where prices do not rise as well as compared to equities. But yes, properties do give you that comfort with a hard asset, having a house, and then you can probably in a longer period of time, if you have 2 3 houses, you can sell it. So there are positive negatives for property market as well, but then you won't find a buyer at the right price like you are able to find it in the stock market, and you won't be able to liquidate that easily. So there are pros and cons, but that is where the you can say the bias of investors are tilted here in India. Gold at 17%, FDs at 16% are the investments basically. 48% go in property, as I mentioned. So that is the thing. Pandemic has led to more investors trading in the market, and so why India do not invest into the market? The famous myth of losing all capital in the market. I believe that one needs to understand this very correctly. So I'll spend a few minutes here. If you buy into a company, say, and this is just an example, just giving you an example, say a Varun Beverages, you buy into that company, and I'm not saying I'm invested there or that is a recommendation. So if you buy into that company and you buy at 500 rupees, and it's a 1.5 lakh 2 lakh crore market cap company. It's not a mega cap, but it is a large cap company. It's into, and we all know it's into the domain of making bottles or cold drink bottles, soft drink bottles. Now if that company keeps on growing at 15-20%, you're making money over a period of time, say 5 7 8 10 years. But if a couple of years go bad, if there is any kind of situation that erupts that makes them sell less, then the stock prices will fall 20 30 40%. And so the risk is time frame basically. So you buy now because of the conditions of war that is happening in the market, your portfolio goes down, or that stock particularly goes down 30% 40%, then you would say that okay, if I would have bought property, it won't have gone down at such a level, or FDs would have grown, and here I'm down 40% already. But if you have a 5 6 year time frame, and if you know that company is growing at 15 18% top line bottom line, then eventually the stock price will double. If the company is growing at 18%, stock price will double every 4 years. That happens because the prices will follow earnings. So if it is down 40%, say 100 becomes 40, 100 becomes 60, 60 will become 400 in 4 years time. So that's a 6x return, and your stock investment at 100 will become 400 over a 4.5 year period. So 1 year lag here and there could happen. 1 year early those prices would come in, or slightly later, but eventually those prices do come in. If earnings double after 4 years, your price will come in after either 3 years or 5 years between that period. And that is the problem with investors, that they invest into the market thinking that you are investing in the market from a 5 10 year perspective, but as soon as your investments go down 15, 20, or even 10%, you are jittery and eventually you sell off and you say that markets are not good enough for me and markets do scam and you don't make money. So stigma of many stock market crashes as well, 1992, 2008, 2020, the pandemic crisis. And there has been phases in the market where overall market has not grown, sectors have done well. So from 1992 till around 97, 98, market didn't do much. From 2001 to 2006, market did well, but I think from 92 to 2001 market did not do that well. 2001 to, so a 10-year phase where markets did not perform that well. So that is the issue at the moment. So Indians like to toil rather than let money toil for them, and that happens. And even though I keep saying to a lot of individuals, a lot of friends of mine, that you should, if you're doing a very good job, you're making good amount of money, you're saving say 20-25%, you're doing all the right thing, but you're putting money into an asset class which will not grow money for you, for your kids, etc. And you have to take a little bit of risk, and risk is only time frame. So if you're 25, 30, you're making money, one should get into the stock market. Yes, when you're 45, 50, the asset allocation could change, but at 25 to 30 or below 25 years of age, one should really get into the markets big time. So are there real risks? As I said, many, but rewards are plentiful. There are global risk, macro as well as micro risk. So if there is tensions, as we have seen across the border, then markets will not perform that well. We are seeing today what is happening. If there were tensions between Ukraine and Russia, markets fell at that point of time. During the pandemic, market fell. During a financial crisis, market fell. And whenever there is a massive financial crisis happening in say large companies, we had the Satyam crash, we had the dot-com bubble in 2000, we had the financial crisis in the US in 2008, then also markets will fall. So markets do fall every 4 5 years. Market will fall 25-30%, even more every couple of years. Every 24 months market will fall between 10 to 15%. That is the Nifty, I'm saying. Small caps will fall more, but eventually when you look at from a 5 to 7 year time frame, you will end up making money if you have half decent companies or invested into the indices in Nifty, etc. So how to thwart the panic? The motto of Mr. Ramdev Agarwal. You need to follow that, and I'm a huge believer in that. Not that that person has said that, but if more time into the market will make you more money and will save you from huge crashes. So I give you an example of one company, Dixon Technology. Now it came out with results in 2024, I think. The results came in or late 23, when they said that there are chip shortages, and so the numbers could be bad for the next quarter, and the stock price fell, started to fall from 5500, went all the way to 2700, I still remember. And from 2700, the stock prices went up from 2700 to 30,000 over the next 2.5 3 years. That's 10x in 3 years. And so if somebody would have bought at 5000, sold at 3000, uh, and then would not have got a chance to get in again, they won't have made money. So one thing I remember in one of the interviews, I don't remember what that interview was, but in one of the interviews he said that during the Harshad Mehta boom, his I think uh, from zero he went to I think 30 crores, and from 30 crores after the burst, it went back to, his investment went back to 10 crores. So 30 became 10, but he said from zero at least I was at 10. So that was the thing, and that was the beginning of the big run that Mr. Ramdev had. So panic sets in if you are uncertain about your time frame. That's where the panic sets in. And if you are uncertain about what you have done, if I bought an XYZ company from a three weeks point of view, from a 3 day point of view, and the stock price fall immediately, you need to exit. You have to carry stop losses. But if you're buying into companies from a 5, 8, 10 year perspective, and you know those companies are doing well, that has no effect of the global tensions that is happening. It's a domestic company doing well in the consumption domain. Yes, the stock prices may go up and down, may go down 20, 25, 30%, but eventually over a 5, 7, 8 year period, you will make money. So time is extremely important to thwart all panic or uncertainty. So this is my first video. Any questions you can definitely write in the comment box. Any suggestion you can let me know, and I'll keep on coming with videos further from here next Friday and going forward as well. So kindly do subscribe to my channel and hit the bell icon, and kindly do at least subscription do not charge you anything. It's a free thing to just subscribe on my channel, so do subscribe to it, and I'll see you in the next video tomorrow.